Hello, my name is Eddie Toftby. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited. As is usual at this time of year, I stopped looking at my daily charts and instead concentrate on the longer term view using my weekly, monthly, even yearly charts. If you'd like to discuss any of these, I'd only be too happy to hear from you. So let me introduce today's longer term chart. Today I'll be looking longer term at ICE Brent crude oil futures. For the last 2 years, the annual commentary here has been one of the longest I make each year. This was in part because the market was difficult to interpret, also in part because so much had been going on. The first question I posed each year was this. Was this, and I quote, action from 2014 a type of descending scallop pattern or not? End of quote. Well, the answer came out yes. The market made a ragged dip in late 2019 and into 2020 before then accelerating higher. A typical move up from such a dip would be about a third of the length of the long ski jump section on top of the recent highest peak. In this case, the target X within the 116 3/4 area. That was the scenario at the end of 2019. Interestingly, January 2020 started a huge move lower that penetrated the 2008 to date mildly bearish lower channel line, currently at 1798. But at no point did it close below it. It was from there that we saw the big long move higher, all the way up to and through target X at 116 3/4. I also introduced 2 years ago something new as an idea. It was to look at the action from 2008 to date as a huge multi-year descending wedge pattern. This was a stretch. The number of touches on the previously mentioned bearish lower channel line, and if finessed with the 2+ touches on one of the trend lines on top, well, it does stack up. It was at this point in my explanation of my idea from last year that I proceeded to shoot my own idea down. It all has to do with how I finesse the upper trend lines. You can see what I mean today. This is one of the reasons why I call my commentaries Eddie's Crayons instead of Eddie's sharp-pointed pencil. I was not happy about having 3 separate downtrends ranging currently in between 59.71 to 71.98. This is in no way an ideal situation. However, it did provide a solution to what may be the dominant pattern here at the end of last year, when prices rose, pushing up through all the moving averages and all the downtrends, optimized or not, though not settling over them at all. It took until the end of February last year to have 2 consecutive closes over all of the downtrends, with a new uptrend currently at 110.59 driving prices higher. Last year I said the following, and I quote, "I feel obliged to detail potential points topside just in case this move higher proves to be true. For this purpose, I will use the lowest of the broken downtrends, the optimized 2012 to date downtrend currently at 59.71. This gives a potential topside target in the 137 1/4 area. It is still a point as I'm not certain as to whether this pattern will work through. We are, after all, still testing the area around any possible break of the downtrend. But that is what it looks like right now." End of quote. Well, by the end of February, this point had become a target X1 at 137 1/4. And by the end of March, the market had reached it and passed through it, but only really by a little before coming back down. The drop was in stages throughout the rest of 2022, through the uptrend, the 1-year moving average, currently 99.62, and the 2-year moving average, currently 87.02, until we are where we are today, testing down to the 50% Fibonacci line of the 2020 to 2022 move at 77.60 and looking at the optimized March 2020 to date uptrend, currently at 75.80. I'm not overly keen on this uptrend, and I can see it being finessed a little more shallower, but I'll leave it where it is right now. Below, in addition to the downtrends of the descending wedge pattern, We have in amongst them a golden cross made in August of the 3-year moving average, currently at 71.82, and a 5-year moving average, currently 70.16. Plus we have congestion based around the 38.2% Fibonacci line for the same move at 63.06 from 2019. All in all, there seems to be some significant support stretching from the 50% Fibonacci line at 77.60 down to the 38.2% Fibonacci line at 63.06. We'll also note the two other earlier golden crosses, but I take them as being part of the run-up rather than the current move lower. It all now depends on what the market will do with this wide congestion area, whether to hold and rise, and we could easily see prices much higher than the high of 2022 fall, and we might see the lower trend line of the descending wedge pattern being visited once again. I'm not looking for a quick solution here. A period of consolidation and reflection by the market for 2023 would be reasonable. But one has never accused this market of being reasonable. Just take a look at the ranges since 2020 to see what I mean. Thank you for listening. This annual broadcast gives the essential market patterns and consequences. Please be aware of the risk disclaimer posted both at the front and the back of this broadcast. Copyright is Eddie Toftpick and ADM Investor Service International Limited. And here comes the final bit.